Money is not free. When you borrow it, you pay a specific fluctuating price called an interest rate. That single percentage dictates the cost of a home mortgage, the monthly balance on your credit card, and whether a corporation decides to build a new factory or lay off workers. But who actually gets to decide what that universal price of money should be? That power belongs to the Federal Reserve. It is the central bank of the United States, an incredibly powerful, yet intentionally opaque institution. Created in 1913, the Fed was designed to bring order to a banking system that was historically chaotic and prone to sudden, devastating financial panics. This committee doesn't decree exactly what your personal auto loan rate will be. Instead, they exercise indirect control, triggering a massive financial chain reaction. To understand the broader economy, we have to look at how a single decision by this institution forces wealth to shift across the entire country. The entire chain reaction starts with one building block, the federal funds rate. Simply put, this is the interest rate commercial banks charge each other for overnight loans. By law, banks must hold a certain amount of cash every day. To meet these strict limits, they constantly borrow short-term funds from peers. This obscure interbank rate is the primary target that the Federal Reserve actively controls. By raising or lowering this single overnight rate, the central bank successfully dictates the absolute baseline cost for every other financial transaction in America. So, how exactly does the central bank force this interbank rate to move? They use monetary policy tools to alter the money supply. Through open market operations, the Fed buys or sells securities, physically injecting or draining commercial bank cash. They also adjust the discount rate for direct loans or change reserve requirements, dictating vault cash limits. Collectively, these three tools control the scarcity of money, and since scarcity drives price, they directly dictate the federal funds rate. Let's trace what happens the moment the Fed decides to raise that target rate. When interbank borrowing becomes expensive, commercial banks suddenly face significantly higher operating costs. To protect their profit margins, those commercial banks immediately pass their new costs directly down the chain to the consumer. Overnight, the everyday borrowing required to buy a car, purchase a home, or finance a small business expansion becomes noticeably more expensive. The dominoes fall in a predictable line, starting in Washington, D.C., cascading through the commercial banking sector, and landing squarely on your everyday checking account. This brings up the macroeconomic motive. Why does the Fed intentionally manipulate the cost of living and doing business in the first place? The institution operates under a permanent mandate to balance two constant threats: runaway inflation and economic recession. If prices are rising too fast, the Fed hikes rates. This makes borrowing painful, which slows consumer spending and eventually stabilizes those prices. Conversely, if the economy is crashing, the Fed slashes rates. By making money cheap, they desperately encourage businesses to borrow, hire, and expand. The Fed is perpetually walking a tightrope, using interest rates as a heavy throttle to keep the U.S. economy from burning up or completely freezing over. This invisible system is exactly what drives the daily financial news cycle. When you see the stock market violently surge or drop following a Fed decision, it is reacting directly to this anticipated chain reaction. Behind these market swings, investors are mathematically calculating the new cost of borrowing for every single corporation in America. The Federal Reserve controls the pulse of the overall economy by setting the baseline price of money. As long as capital dictates how the world functions, the Federal Reserve will remain the ultimate mechanic in the shadows, deciding exactly how fast the machine is allowed to run.
Share, like, comment, and subscribe.